Thanks, Peter. I think this is an incredibly interesting topic, very relevant for the moment and very real read across a number of asset classes and whether you invest in China or not. Betting against Chinese progress when it comes to commitments on climate change for some time has been a losing strategy. You may not think of China as a green country, but off a low base, it is making remarkable advancements in this field and hitting the gas, so to speak, and accelerating efforts forward. This has been most recently demonstrated by China's premier's radical commitment for the country to be net carbon neutral by 2060. This is important as China is the world's largest carbon emitter. If we could have the next slide. It's a country that's fast growing in scale and size. In 2021, as you can see from this chart here, China accounted for about 27% of all greenhouse gases globally. Incidentally, this is a chart by the Rhodium Group. And as you can see from it, that's more than the greenhouse gas emissions across the EU, US, and all other developed markets combined. So for all the vegan burger eating, Tesla driving, soya latte drinking, it really is China that at the end of the day is where the key cog in terms of change in regards to sustainable energy commitments and transition to a more carbon-free global economy. I'm going to focus on 4 areas now, and we could go to the next slide. We can just see what these are. The first area is progress at a price. So just talking a bit about why China is where it is in terms of environmental issues. The rubber hits the road, what China has already done in terms of progressing forward with green commitments. Evolution to revolution, what recently their commitments mean. So that comment by President Xi at the UN saying that committing to being carbon neutral by 2060, what they'll actually have to do to get there. And finally, importantly, of course, impact both for companies, investors, and kind of energy markets in general. What does this ultimately mean? So, over the past handful of decades, due to ambitious economic reforms, China has achieved a miraculous boom in economic activity, pulling millions out of poverty. From copper mines in Chile supplying infrastructure projects to high-end European fashion catering to a prospering Chinese middle class, the effects of China's ascent have rippled across the global economy. And that's very clear. However, these achievements have come at a cost. China's progress has relied heavily on energy-intensive industry. This is in part inherited from China's pre-reform period and part due to China's investment-led growth model. For example, to keep up with an ambitious infrastructure development plan in the period 2012 to 2015 alone, China used more cement than the US did in the whole of the 20th century. That was subsequent to the global financial crisis package that they put in place to stimulate the economy. As a consequence of this, China leads in many of the global resource markets. So for sources like copper, aluminium, and cement, China has over or around half of global demand. China's rising appetite for energy has largely been met with a carbon-intensive supply. Plentiful coal resources in China led to coal-based power generation becoming the primary means of energy generation. Even now, compared to the US in 1950, the portion of coal in China's energy mix is around 1.5 times greater. The consequence has been that particles from coal-powered electricity generation in China have created serious health concerns across some of China's most densely populated cities. In Beijing, for instance, and I spent about 5 years in Beijing, I love the city, but there is a very clear issue. One example which was cited to me recently was that despite the significant decline in smoking rates in China, lung cancer has nonetheless increased by 60% over the past decade. Even for electric cars, when fueled on electricity generated by fossil fuels such as coal, the environmental outcome is actually worse than that had it been powered by petrol. So this is a very real issue in China, and as people's wealth in China increasingly they are keen not to simply grow at any price, but have a more balanced approach to growth going forward. This combination of an energy-intensive growth model and a carbon-intensive energy supply has created a considerable carbon footprint. In the past 20 years, CO2 emissions in China grew 6 times as fast as the rest of the world, and China accounted for almost 2/3 of the growth in global CO2 emissions. By the time COVID-19 had struck, China had roughly higher per capita CO2 emissions than the European Union's, albeit still below the US, of course. China has onto the next point in terms of the agenda, where the rubber hits the road. China has, of course, already been no shirking wallflower when it comes to energy transition. The country has already been implementing policies to manufacture to manage the environmental impact of its economic development. Heavy industry, for instance, has been forced to relocate far from city centres and required to meet higher environmental standards. In addition, many coal-fired power plants have been ordered to shut down entirely. So in Beijing, for example, where I used to live, the city used to have 4 coal-powered power stations. Those have now all closed. China is also pressing ahead with more sustainable means of energy production. In 2020, for instance, China built almost 100 gigawatts of wind farm capacity, a 60% rise on the year before. That made it the greatest increase ever achieved by a country, and more than the whole world combined in 2019. I'm, of course, British, and to put 100 gigawatts into perspective for myself, that is almost 3 times the power required for homes across the UK. The UK, of course, having a population of around 60 million. I think we actually got a slide on that if we can move forward to the next slide. Yes, so I mean, this is just 2020 and it will vary year by year, but that chart there, the pie diagram, gives you an idea about how important China is to the wind energy industry alone, followed by the US. Also, while China is therefore starting off a low base, the country is already demonstrating that it is a leading player in sustainable energy. Therefore, to understand the direction and pace of change in sustainable energy markets, the policy from Beijing is important to understand. Another energy market, of course, that China's particularly large participant is solar. If we can move to the next slide. Solar, of course, has also been a key pillar to China's sustainable expansion plans, despite, frankly, large parts of the country not being particularly sunny. The country already boasts the world's largest solar power capacity, nearing almost double the installed capacity of the entire European Union. Moreover, China is a key supplier of solar equipment, dominating production across the supply chain in most of the vertical. For example, more than 2/3 of polysilicon, solar cells, and solar modules are now produced in China. So we'll just move on to the next part of the talk: evolution to revolution. What is China looking to do going forwards now? As while tremendous progress has already been made, far more needs to be done. Policymakers based in Beijing, however, are, it seems, rising to the occasion. And in a speech by the President Xi late 2020, as noted, he did commit, or at least say China would target to be carbon neutral by 2060. And actually, Chinese policymakers, by and large, have a pretty good track record of meeting or beating their own targets. And this is a radical undertaking for China, considering China's existing carbon footprint, and also very important, considering its existing legacy assets. To meet this target, China will likely need to take a two-pronged approach. That is, reduce energy intensity and further improve its energy mix. In the first instance, energy intensity reduction gains will primarily be driven by China's rebalancing of the economy. Less than a decade ago, China was known as the factory of the world, dominating production in terms of cheap goods and as an export powerhouse. Increasingly, however, it is domestic consumption which is driving growth. Rising disposable income and an increasingly educated workforce in the country has, for instance, opened up service sector opportunities, and these are frequently a far less carbon-intensive source of growth. In addition, the kind of the kind of services that it's exporting now. For instance, what it is doing in IT, in healthcare. Again, even its exports, the global economy will likely be increasingly less carbon intensive going forward. Managing carbon intensity can also be achieved by more stringent standards and regulations on energy efficiency. The scope of such policy can range from factories and industrial equipment through to appliances and buildings. Fortunately, development in this space has also encouraged the type of higher skilled jobs that policymakers are keen to promote in China. Beyond energy intensity initiatives, overhauling China's energy infrastructure mix is another key undertaking required to meet China's targets. There's quite an interesting paper actually on this by the Oxford Institute on what China's commitments would likely mean in terms of energy intensity. I think in a lot of these papers I often take with a pinch of salt, and I thought this one was quite radical, but just to give you an idea of what it was citing, it said for China to meet their targets, currently around 80% of China's energy still comes from fossil fuels, but for China's plan to work, it is envisaged that by 2016 only 14% will come from coal, oil and gas by that year. So this has significant implications in the allocation of capital for domestic energy markets and will likely lead to further regulatory pressures on emitters. The impact of China's policy implementation, combined with the efforts of other nations, will likely become increasingly evident in capital market pricing actions over time. Corporates and investors alike have been achingly slow to respond to this shift, in my view, and indeed there are still those that have their head dug firmly into the sand. However, change does not require a belief in man-made climate change, and I fully appreciate that there's many skeptics over the science and indeed questions over the science, but all it does need is an appreciation that policymakers do believe in it and are taking considerable actions to combat it. Many companies, of course, are already in risk mitigation mode, although in numerous cases the effort is frankly more of a PR push than a strategic operational overhaul. There still remains an outstanding level of cognitive dissidence in this respect. And for some companies, it's proven easier to outsource the less savoury parts of the production process down the supply chain. I know this because I spent years and almost a decade looking at emerging markets, many of these supply chain companies. And I guess one important aspect I learned is out of sight, however, will not be out of mind. Increasingly as change is required and cost pressures mount and do get passed back up the supply chain to those companies. As for equity investors, the majority of institutional asset managers have in recent years produced extensive sustainable investment statements, particularly here in the UK. These, however, very often prove very hard to square with a company's underlying holdings. Some investors, of course, argue that changes in the price, and indeed for some companies it likely is. However, in many cases, and I'd almost say most cases, it is as evident that financial markets are far more interested in the next 2 years than the next 20 years. Valuation process approaches, for example, have frequently remained very much anchored in historical book values or recent dividends, rather than looking beyond the horizon and understanding what change in countries like China means to a company's long-term prospects. And as a result, it remains the case that, in my view, there's considerable value at risk, especially for those companies that are exposed to China when it is transitioning and combating some of the kind of higher carbon intensive industries. So in summary, Warren Buffett famously quipped, only when the tide goes out do you discover who has been swimming naked. This, unfortunately, is likely to be true for many companies and investors, as pressure from regulators and consumers exposes those unwilling to adapt. This will be most evident for holdings exposed to China, where the old model of economic development is being overhauled and business is no longer as usual. I'm happy to take any questions if there are any.